Dobar dan. That means good day. This is TalkCast PDX. You can find us on the web, talkcastpdx.com. It's Tuesday, June 8th, 2021. Show is called The Bogdanich Perspective. I'm Paul Bogdanich, your host, and welcome. Title of today's show is Outta Here, or Ring 'em Up, excuse me. Title of today's show. Got an email from Donald. Donald wanted me to talk about dividends. A dividend is a payment that you receive from a corporation just for owning the stock. They pay them quarterly. They're measured by how much the annual dividend is, but they pay them quarterly. And they set what's called a record date, and anybody who owns the stock on a record date receives the dividend, and the dividends are in per share amounts. I'm going to use Verizon Communications as an example. They pay $2.52 a year in dividends, so that's 4 payments of 63 cents per share per quarter just for owning the stock. Now, the way that they measure the size of a dividend is they use something called the dividend yield. And the dividend yield is where you take the total amount of the dividends that you're going to receive in a year. In our example, Verizon here, $2.52, and you divide that by the share price. And as of last Friday, Verizon was trading at $57.25. So if we take that $2.52 and divide it by the share price, which was $57.25, we get 4.36%. Now, in large cap stocks in the S&P 500, that's called the yield, by the way. A typical yield will run in between something less than 1%, 0.2%, 0.3%, all the way up to 4, 5, 6, sometimes 7%. If you see a company with a dividend yield above 3.5%, you have to look carefully at it. Some companies pay this much normally, like real estate investment trusts and so on, insurance companies, things like that. But if it's not a company like that and it has a high dividend, the way that the dividend yield is calculated, you have the dividend divided by the share price. It could be because the share price fell or is falling. So if a company has more than a 3.5% yield, you kind of have to look at it. But again, just for owning the stock 4 quarters a year, and the only other thing I would say is favorable tax treatment if you earn very little or a lot. Other than that, it's kind of the same. Markets closed last Friday, at 4,229.89 points, and that's 3 points within 3 points of their all-time high. If you recall, if you've been following me at all, we created 4 portfolios, hypothetical portfolios, and 3 of them were index trackers for the S&P 500 index, and we'll talk about those later. And then 1 was a discretionary portfolio that I put together, and my criteria for picking stocks for that portfolio was it had to have a dividend, I wanted a moderate P to E, and I wanted some potential for income growth. So I picked a bunch of stocks. We did that on April 9th, and today's June 8th, so that's exactly 60 days, 2 months. And so far, over 60 days, my discretionary portfolio, which I call the large liquid leaders, is up 3.85%, which is not bad. But yeah, I did a 2-month review of the stocks, and we had some stocks, 8 stocks go, there's 24 stocks in the portfolio, 8 were up, 16 were down. And I looked at them all, but particularly the 8 that were down, and we have 5 stocks that contributed more than 90% of the losses. So I'm going to look at those in some detail. I created a creed that sums up the way that I think about the markets, and I've read it in prior episodes, and I'll read it again, I'm sure. But I'm not going to read it today, but I'm going to read 2 paragraphs from it just to let you know how I think about these things. Looking at what's left of the bond market, lying in what's left of Wall Street, and wanting to earn more than 2% on our savings, we are functionally compelled to participate in the stock market. There simply is no other risk-free or low-risk alternative that pays more than 2%. And that's 1 paragraph. And what I mean to say by that is that if you have a bunch of passive money, retirement savings that you just need a reasonable amount of income on, bonds pay so low, annuities pay so low that you're kind of stuck, and you really, stock market's about one of your only alternatives. Best place to put it. The other paragraph that I would like to read from the Creed goes like this. Artificially low interest rates also destroyed the former correlation that used to exist between stock prices and interest rates. This disconnects the value of a share of stock from any calculable underlying value, and the share of stock becomes worth whatever someone else is willing to pay. More buyers than sellers make stock prices go up, and more sellers than buyers make stock prices go down. That's the end of that paragraph. And what I mean by that is in the modern markets, especially for the last, call it 5 years, it's a popularity contest. We used to evaluate stocks based on objective value measures, earnings growth, this, that, and the other thing. And increasingly, as time goes on, those things are taking a subordinate position just to how well the stock trades and how popular it is. And it's frustrating for old timers like me sometimes, but it's very important, and you have to pay attention to that. Back to the large liquid leaders, which was my discretionary portfolio, we had six stocks, that are down over the last 60 days. Those are Microsoft, which is down 1.9%, Broadcom, which is down 2.1%, Home Depot, which is down 2.6%, Lowe's, which is down 4.3%, Apple, which is down 5.3%, and Thermo Fisher Scientific, which is down 6.3%. As I said, I picked these stocks we put together the portfolios on April 9th. That was shortly before companies started to report earnings for March 31st. And I picked these stocks based on moderate P/Es, a good dividend, and potential for earnings growth, good earnings. And we did real well. All these stocks reported very good earnings. And we have 24 in the portfolio, and those 6 are all down close to 2%. So kind of got to look at why. If we look at the stocks in particular, Microsoft and Apple are the numbers 1 and 2 stocks in the S&P 500 by market capitalization. Apple alone is about 7% of the value of the S&P 500, and Microsoft alone is about 6%. If you've listened to my shows, one of my broader theses is that the Federal Reserve of the United States, needs to control how high the market goes, as well as protect against any unreasonable corrections. So it's my hypothesis that these large capitalization stocks are going to underperform the index. So some underperformance of Apple and Microsoft and Procter & Gamble and stocks like that is expected. But nevertheless, Microsoft for the 60 days is down 1.9%. But we took care of that on, it's June now, so I guess it was April 14th. We sold the July 9th 245 calls, and we got $12 a share. So if the strike price is $245 and we got $12 a share for the calls, we're good on Microsoft all the way to $57.50. So that one's, we'll hold it, because we have the call protection on that one already. That brings us to Broadcom. Broadcom is down 2.1%. They reported earnings on June 3rd, which is just last week. Revenues were up 15%. Earnings were up 30%, 29%, but 30%. And the stock did not respond as I had hoped. Their dividend date was June 21st, which is their dividend date is June 21st, which is not this coming week and not next week, but the week after that. And I'd kind of like to pick up the dividend because it's $3.60 a share, but I looked at the calls, something to stretch it out that far to protect myself from further price diminution. I didn't see anything. And I'm afraid we have to sell it. So it's out of here. Ring them up. Sold it at $476.47 a share. On Broadcom, we paid $4.85 a share 60 days ago, so we took a loss. That brings us to Home Depots and Lowe's. Similar businesses. Well, everybody's been to a Home Depot or a Lowe's, right? I don't need to tell you. So similar businesses. I bought them before earnings. They reported absolutely stellar earnings. I just can't stress that enough. Lowe's in particular, the analyst expectations on the earnings, what the analyst consensus was for that quarter was $2.60 a share, and Lowe's comes out and reports $3.20. All right, that's huge in terms of a percentage profit. It's like 30% beat. And let me say that again: $2.60 a share versus $3.20. And they reported that Home Depot had similar earnings, and the stocks they failed to go up. In one of these companies, they're having the conference call, and the CEO is on the conference call, and he's got these great earnings to report. His revenue is above expectations, his earnings is above expectations, everything's great, right? And he's got these great revenues to report. They get to the questions, and an analyst calls in, and one of the analysts says to the guy, he says, "Tell us how soaring inflation is going to decrease your revenue." And the proper answer to that question in your role as a CEO is, well, soaring inflation, if there is any inflation at all, is not going to decrease my revenue. If things cost more, my revenue is going to go up. So I don't see this as a problem, but and so on. And then you talk about how good things are, right? And he didn't do that. He likes to talk about things, and he thinks about inflation because he's a forward-looking CEO. And so he gets into a discussion with this guy. He morphs into an economist with a crystal ball, all right? And he starts agreeing with the guy that, inflation could have an effect. And he talked his own stock down. It was a great earnings. It was set to go up. He gets on the call and, starts doing this and talks his own stock down. Now, normally, when that happens, and it's more common than you would think, I kind of laugh it off. And that's what I did at the time. But because typically what happens is the stock will go down for 4 or 5 days or something, just based on what a chump, right? But the week after that, the earnings were so good that people buy the earnings, but that's not what happened. They reported like 2 weeks ago. In the week after these dreadful calls, great earnings, but dreadful calls, the stock dropped 2.5%. Last week, this is the week after earnings. On Home Depot, the stock fell another 2.5%, and on Lowe's, it fell another 2.5%. So it's 5% in 2 weeks, on stellar earnings, right? So my thinking is, I did what I could do. I did all I could. I identified a company that I thought was going to have great earnings. It did have great earnings. The stock doesn't trade. What am I going to do? Wait for next quarter for it to have great earnings again? Is that going to help me? So no. So we sold them out. Ring them up. We sold the Home Depot at $311.52, and we bought it at $319. Good size loss. We sold the low at $189, and we bought that one, unfortunately, at $195. So, not good. So, but we sold them out. Don't have to worry about them anymore. Which brings us to Apple. And like I said, Apple's the largest stock in the S&P. It's predictable. It's regular. Good CEO doesn't make stupid mistakes like that. Typically very good earnings. And I've been watching it long enough where it has a pattern that as you approach the earnings date, investors, the investment community broadly, starts to speculate on what the earnings is going to be, and it usually adds price prior to the next earnings date. And their next earnings date is going to be, call it mid-August. But I'm worried about it going down kind of a little bit, being soft in between now and then, because it is one of the largest stocks, and I think the Fed has an interest in adding liquidity to it, selling shares, read that. I don't want to sell it at this point because I would rather wait until it's on that little climb on earnings anticipation. So I wrote the August 20 $125 calls, got $6.25 per share per contract. I plan to monitor that carefully, try and sell them before the stock runs up in earnings anticipation, round trip them. Won't dump the stock unless I have to, but I took out, trying to whittle the basis down a little bit. And that leaves us with Thermo Fisher Scientific. Tough one here. They reported earnings on April 29th. Revenues were up 70%, right? And earnings were up 200% over last year. Okay. So let me say that again. I mean, revenues up 70%, earnings up 200%. And that's kind of why I bought it, because I thought that they would have good earnings like that, and they did. The call wasn't bad like it was in those prior examples, but it wasn't good. And after the call, the share price fell from $4.90 to $4.70 a share. And I was disappointed with that. But I thought it would recover just because the earnings were so good and the outlook wasn't bad. And it did start to recover. It started to add price. But Thermo Fisher has some common product lines with Abbott. And last week, Abbott had a very bad report, and the CEO was glum on the call, and he had, he talked down his forward-looking expectations, all the rest of this. And in sympathy with Abbott, not because of anything Thermo Fisher did, but in sympathy with Abbott, the share price lost $20, another $20 a share last week. And that put it into this, whatever it is, 5.3% loss position. Looked at that. This one's tough. I could have sold it or whatever, but on this one, I sold the July 16 $440 calls for $17.50 a share. If they take them away from us, we get $457.50, which is all right. Brings us back to even. If the stock continues to be soft, then we whittle down the basis by $20. So that's what I did to adjust at 2 months for the losers in my portfolio. Then I went over the winners, and we have to do something about one of the winners also. I see a possible change in promotional situation, their ability to promote their own stock, which, I mean, look at what just happened on the earnings on Lowe's and the earnings on Thermo. I mean, earnings by themselves aren't enough. You need a management team that promotes their stock. And Pfizer. We own 109 shares. As of last Friday, it was up about 7%, so it's doing pretty good, making us money, huh? As you may know, they're making a little of their money right now by selling these COVID vaccines. And it's what's called an mRNA vaccine. And there's been some developments that I'm concerned will impair management's ability to promote the stock. Nothing to do with their business or anything. Just I'm concerned that their stock price will be soft. I'm an investment guy, not a biochemist. But I'm concerned that the stock price will be soft. Short version goes like this: the way the vaccine works is it's called an mRNA vaccine. This is the first time we've used them in large human populations. They inject it into the deltoid muscle, right here. The vaccine stays localized in the muscle that it's injected in, and it causes the cells around the injection site to produce what are referred to as spike proteins. And these spike proteins are identical to the proteins that exist on the outside of the coronavirus. So the way it goes is your immune system sees these spike proteins that the vaccine makes you produce, and then it develops immunity, and voila, you have immunity to COVID, right? That's the way the vaccine works. A few weeks ago, a researcher, I think it was Canadian, but don't quote me on that, he concentrated a solution of just the spike proteins, no virus fragments, just the spike proteins. And then he took this concentrated solution and he injected it directly into the bloodstream of mice. Then he autopsied the mice. And he found that just the spike proteins, in absence of the virus, caused microthrombi, which are very small blood clots, in the internal organs of the mouse. And that essentially means that the spike proteins that are being created to cause the immunity are what's referred to as a pathogenic protein. They're pathogens. Last week, Japanese researcher came out and said that they did a biodistribution study, and in human recipients of vaccine, there's a very small amount in human recipients that hits the bloodstream, about 0.3 of a microgram. A microgram is 1/1,000,000th of a gram. I don't know what that means, whether that's a lot or a little, I have no idea, but these are just negative press things, Also, last week, the Israelis come out and they said that there's a statistically significant link in between recipients of the vaccine and these small blood clots in young men. In America alone, since December, we've given 300 million doses of this vaccine to 170 million people. If anything was wrong with it in terms of a large or severe effect, we would have seen it. Right? 300 million doses into 170 million people. We don't. So these effects are likely small, but because it's medical and because it's this and because it's that, and because the spike protein itself has been identified as a pathogen, they're going to have to do animal studies, and then they're going to publish the results of the animal studies and blah, blah, blah. And that's not what concerns me. What concerns me is it gives an opening to people who, for financial or other reasons, just because they don't like Pfizer's vaccine, for example, or competitors, or anybody who's would rather see the stock go down than up, it gives them an opportunity to do what's called FUD, fear, uncertainty, and doubt. You get your press arm together, you start talking up the results of these studies. You hit them with some negative articles, some negative press, and it impairs their ability to promote their own stock. And also, it's a medical concern, and I've been doing this for 20 years. And anytime you have a big medical company, your retail component is a bunch of doctors. They like your company, they like your products, they like your stock. And so your entire retail component is a bunch of rich doctors. Because they're rich, their positions are heavy. This is a $90 stock, so it would not be uncommon for them to have 50,000 shares a person. And studies like this, when it comes out, makes those guys nervous. And it's just a negative for the promotion of the stock. As I just say it again, lows, 260 a share to 360 a share, and the stock didn't go anywhere. So it's not that it means anything. It's just that I'm concerned that it impairs their ability to promote the stock. And I want some protection. I don't especially want to sell it. So I did what it's called box the position. You essentially protect the current price you're at, and you protect on the downside. So I sold 11 of the September 17 $40 calls, and I got $1.12, which is nothing, right? But then I bought 10 of the September 17th $38 puts, and I paid $1.16 for them. So the call money went into the puts. If the share price stays right where it is, I get called away at $36. They take my shares at $40. I paid $36 for them, so I capture my gain. If this FUD campaign is, or my anticipated FUD campaign, what I think will happen, is successful, then I make money as the share price drops and I still own the stock, so I'm protected either way. And that is my cleanup on the portfolio at the 60-day mark, my discretionary portfolio. The other three we created for are all index trackers, and we're going to talk about them now. We created 4 portfolios, and 3 we wanted to highlight different portions of the S&P. So for the first 2, what we did is we took the top 30 stocks in the S&P 500. And the way the S&P 500 index is calculated, it's what's called capitalization weighted. So the top 30 stocks represent more than 50% of the value of the entire index, which is the top 30 stocks represent as much value, a little more than the other. There's 505 stocks in the index, so the other 475 combined equal the top 30 stocks. So we picked a list of the top 30 stocks just by market capitalization, and we created 2 portfolios out of that. One was capitalization weighted, just like the index, so that portfolio is a proxy for the top capitalization stocks in the S&P 500, concentrated in the very top capitalization stocks, top 30. And the other one we equal weighted, which is still the top 30 stocks, but they're equal weighted, so it puts more emphasis on the individual performance of the portfolios. And we call those two portfolios the top 30 cap weight and the top 30 equal weight. But when you pick just the top 30 stocks in the S&P, you wind up with a portfolio that has 9 stocks in internet technology and 7 stocks in communication services, which is 16, and you only have 30 stocks in there. So more than half of your portfolio is in 2 sectors, and it's concentrated, it's skewed, right? So to correct for that skewing, we created a third portfolio. And there's 11 sectors in the S&P 500, and we just merely took the top 3 stocks per sector from all 11 sectors. So 11 sectors, 3 top stocks in each sector, 33 stocks. And that portfolio is called the top 3 by sector. And then I have my discretionary portfolio. For the week ended last Friday, S&P 500 closed at 2,229.89 points. And that's an increase of 0.61%. So if you had $100,000 in a portfolio, in each one of our hypothetical portfolios, we started with $100,000 in April 9th, your portfolio should have returned $613 if you'd have been keeping track with the S&P. Now, the top 30 cap weight only returned $474 instead of the $613 that was expected, so they underperformed. The top 30 equal weight only returned $362 compared to the $613 that was expected. So that's very badly underperforming. The top 3 by sector, which is the 11 sectors, 3 stocks per sector, that one returned $773, which is good. The expected return was only $613. We got $773, and this is just for a week, mind you. And my discretionary portfolio returned $752, which is also pretty good against the expected $613. So let's look at the constituent stocks in there and see how the individual names did. The top 30 cap weight, this is the one that only returned $474, only had one loser above $100, and that was Tesla, subtracted 157 from the portfolio. It had 3 winners. NVIDIA added 213 to the portfolio, Google added 147, and Apple added 124. So the portfolio went up 474 against an expectation of 613, so underperformed. The top 30 equal weight, same stocks, right, in there, had 2 losers. The losers were, again, Tesla, but even worse than Tesla on an equal weight basis was Abbott Labs. That's what dragged Thermo Fisher down, if you'll recall, bad report. But Abbott Labs subtracted $206 from this portfolio. Tesla subtracted $131. Had 2 winners. NVIDIA, again, added 320 this time instead of only 213, which is the difference in between capitalization weight and equal weight. And then ExxonMobil added 185 to the equal weighted portfolio. And again, our worst performer, only returning $362 against an expectation of 613. Then we get to the top 3 by sector. This was our best performing portfolio. Added 773 against an expectation of 613, I think it was. Yes, 613. And 2 losers, and you can guess what they are, Tesla and Abbott, right? Abbott Labs subtracted 184, and then Tesla subtracted 105. 6 winners, and the winners are interesting. I'm going to do them 3 at a time. Okay, the top 3 winners were ConocoPhillips adding $242, Exxon adding $166, and Chevron adding $135. Now, remember, this portfolio is the top, all 11 sectors in the S&P top 3 stocks. But Conoco, Exxon, and Chevron are our 3 stocks in the energy sector, right? So the energy sector just killed it last week, outperformed every other sector. And that was 3 of the 6. The second 3 of the 6 are American Tower added 128, Prologis added 127, and Crown Castle added 123. And American Tower, Prologis, and Crown Castle are all real estate, right? So last week, everything that drove the S&P was not the large cap stocks. They badly underperformed. It was essentially the energy and the real estate sectors. And if we look at the composition of our portfolios more broadly, the top 30 cap weights, where we just pick the top 30, only have one energy company, that's Exxon, and no real estate companies. The top 3 by sector, because it includes every sector, 3 stocks per sector, had 3 stocks in each sector, and those were your top 6. In my portfolio, I have 2 energy and no real estate, and that's why that one outperformed everybody. But those 2 sectors. Back to the large liquids leaders, sum it up. I made those changes on Friday. Before Friday, it was up whatever it was, 3.8%, pretty good, but I'm trying to improve it. After the changes, we started with $100,000. After the changes, it has $91,046.38 in equities in it. And it's got $13,229.72 in cash. And that totals $104,276.10. So, including the cash and the outstanding puts and calls, and I took the most conservative assumptions possible when calculating these, we're up about 4.28% in 60 days, which is pretty good. I have $13,230 in cash. The average investment in a stock in this portfolio is about $4,200. So I can buy 3 new names, or I can add some money to some of the existing names, or I can keep it in cash. And I'll decide what to do about that next Friday. And I'll give you the results next Tuesday. And that's about it. Email me with questions, comments, or suggestions. You can email me at Paul@StockBetter. That's Paul@StockBettor, BETTOR.com. Thank you for listening. Join me again next Tuesday, TalkCast PDX, on the web at TalkCastPDX.com. Name of the show is The Bogdanich Perspective. And do widzenia. That means goodbye.